Welcome to Fundu Money, your 24 into 7 buddy for all your money matters. Tax saving investment season is all set to come to an end, and you might be wondering what are the last minute efforts you need to do to maximize tax saving investment benefits that you can get. And here, one of the most important things that we at Fundu Money thought we would point out to is that whether you're asking yourself the following question: is your tax saving investment actually taxing? Yeah, that's right. A lot of people go ahead and do their tax saving investment without realizing that these investment can actually be taxing. You want to know more about the details, you need to wait just a little longer. The good news is that with us is prominent financial expert Swami Saran Sharma. He will tell you why tax saving investments can actually be quite taxing. So just wait a little longer. Well, Swami, most of the people do tax saving investments and they get their Section 80C benefits. But there are two other aspects of an investment which most people miss out on. One is the taxation of returns, the other being the taxation of maturity proceeds. Now, whether it's life insurance policy, ELSS, your tax saving FDs, they have their various treatments, isn't it?
Right. Right to then, yes.
So, when a person is actually evaluating a tax saving investments, what are how does that person figure this out? When they're comparing, should they be also checking out how the returns or the interest is getting treated and how the maturity is getting treated? So let's take some of the most popular ones. One is ELSS, the other is life insurance plans, third is any small savings plan, and the fourth being NPS.
Okay. See, fortunately, these first two which you mentioned, like ELSS, and ELSS has a lock-in period of 3 years. And after that, once you take it out, it is tax-free since it is an investment in the equity market. Second, you mentioned is life insurance policy. Supposing if you see there is a small the premium policy, it should not exceed 10% of the total amount, total sum insured. In case it does, then the deduction is not available. But in case it is less than 10% of the sum insured, whatever premium you pay today, majority of the policy, the entire proceeds is tax free.
Okay.
Whereas
So,
this
if you were to recapture it, if you were to summarize what you said about this 10% thing, so that people, just for the benefit of people, if you could just run it again, very in brief, 10% of sum assured, you're saying?
yes.
Okay. So if the premium is 10% of sum assured, you qualify for the deduction. If it is less than that, you're not qualifying for it, is it?
No, if it is less than that, only then you qualify. I'll give you an
Okay.
example.
Okay.
Supposing if the sum insured is 10 lakhs.
Yeah.
So if you are paying premium in excess of 1 lakh rupees, you will not qualify for deduction under this section. If the premium is up to 90,000 rupees, it qualifies for deduction. So one has to take care that while investing, they have to see this essentially means that your period of investment will be around 10 years at least.
Sure. So basically, in a tax saving FD, these benefits, ELSS and life insurance kind of thing. But ELSS, of course, is long term. It's an equity investment, so more than 1 year, it automatically returns are
Yes.
tax free, maturity is tax free. But in a
Right.
tax saving FD, you're getting taxed on both the ends. NPS. national pension scheme, it depends on the variant, right? I mean, if it's an equity kind of variant, then it'll get taxed accordingly. If it's got a debt component, I think the definition is 65% in investment in equities. So basically, the in Public Provident Fund, of course, it's tax-free all
It's
through.
tax free. Yeah.
And how about national savings certificates? I mean, you get a
So
Section 80C.
yeah, that national savings certificates are taxable. The interest earned on NSCs are taxable, but they again as reinvestment under the same section.
Sure,
Supposing
sure.
if you bought say national savings certificates for a lakh of rupees, and the interest is 6.5%. So next year 6,500 rupees can again qualify for deduction under section 80C. So that much less you need to save taxes.
Sure, sure, sure. So basically, the bottom line is, even at this last 11th hour, if you're making a tax saving investment, you need to keep this in mind.
Yes.
You should not just rush and take a look only at the deduction you're getting. You need to know whether that money is going to grow, because at the end of the day, you're going to have to save enough. You're doing it for a purpose, just not for saving taxes. Thank you so much, Swami. I'm sure this information is useful even at this 11th hour. What are the other topics that interest you related to tax saving investments? We might not be able to make it in time for this financial year, but we have the benefit of having Swami with us. We'll revisit these ideas and your issues. Please take a look, use the closed caption feature for this video. We are doing this through Hangouts, and there are often internet slippages. So it'll always help you to get the highlights of the discussion on the closed caption feature. Apart from that, you check out the description section. There are useful links and information. Stay connected with us on all leading social media platforms, and of course, visit our website www.fundomoney.com.